Inflation fears will not go away. Meanwhile, we've got jitters over tariffs and stocks under pressure today. A closely watched inflation reading indicated that US inflation was high last month, or higher than the Fed would like to see. That's making investors nervous. We're getting more from Young Ma, Chief Investment Officer at BMO Wealth Management. Thanks very much indeed for joining us. Could you start off, please, by talking about inflation? It looks like the Fed just can't get this beast into its grave.
Thanks, Andy. It's great to be here. Well, yes, I think there still are some lingering inflation pressures. There are also some deflationary forces at work, but the big issue right now at hand, of course, is tariffs are going to add to inflationary pressure over the next 12 months, especially if we get this reciprocal tit for tat after reciprocal tariffs and retaliatory tariffs. I think that's going to add to concern, add to uncertainty, and something that consumers and corporations are going to have to contend with. So it is an environment where there's heightened risk in the short term here.
And you're looking for a choppy month. You already touched on the tariffs. We're expecting more on that from President Trump on April 2nd. Meanwhile, though, you think broadly economic data could show signs of weakness as well in April?
We do think that's fairly baked in at this point. A lot of survey measures are pointing in that direction. It's not just consumer sentiment, which doesn't actually tend to have a lot of predictive power for spending, but a lot of the survey measures we're seeing out of the regional Fed banks for what corporations are going to do, corporate spending, hiring plans, all of these things are starting to weaken in a way that looks like there's a collective pause that's going to take place in the economy until some of these tariff concerns are in the rearview mirror, which could still be a couple of months away.
You do think that the Fed will cut rates maybe 2 or 3 times this year, even though it's having such trouble suppressing inflation?
I think the Fed is willing to look past the inflation concerns on the belief that they will primarily be short-lived still being maybe 9 to 12 months. But if they're tariff driven, they should not be long lasting in terms of ongoing inflation. And the big question is going to be whether or not the labor market weakens in the coming months, which we do think there's a good prospect of that. And paradoxically, the stock market is probably looking for the labor market to weaken so that it can have that Fed support from rate cutting in the coming months. So I think you have a dynamic here where if the labor market actually holds up better than expected, and given those inflationary pressures, that could be a concern that we're not going to get Fed rate cuts.
3 sectors you're watching: home builders, airlines, and regional banks. Now, I think this is primarily in the United States. Why could they be an important indicator of a broad market upturn?
Yeah, those 3 areas, the airlines, home builders, and regional banks, we do think are important bellwethers right now in the market for seeing where a bottom forms and an eventual upturn starts to take place in the U.S. economy. One reason is that home builders have been under such and the housing market itself has been under such severe pressure. Although it's not a huge part of the economy, it's still an important indicator for if there can be a credit cycle that resumes in the U.S. where people are willing to take out loans, willing to take on leverage, willing to make these big ticket purchases. So home builders are important. Airlines are important just for consumer spending and corporate spending. Is there enough confidence for people to be willing to take that extra vacation, for corporations to be willing to put in these additional resources and expenditures? And finally, regional banks, there's still some concern about the commercial real estate market. And regional banks are front and center in the U.S., are front and center in terms of those commercial real estate concerns. So we want to see stability there, with the idea that those commercial real estate concerns are in the rearview mirror as well. So those are 3 areas I think are important forward-looking indicators for the health of the economy and the rest of the market here.
But broadly speaking, you would prefer to be in big cap banks right now than smaller regional lenders?
Yeah, absolutely. One reason that we're focusing on those more regional lenders is because if there are strains, that's where they would appear. In terms of investments right now, we do think large large cap banks are a much safer and more stable area to be in terms of financials, which we do think will do well in the environment of lower regulation going forward, even though these couple of months could be choppy here still.
And communication services is an area of interest to you. What do you mean? Telecom, mobile phone providers?
In the U.S., the communication services is actually dominated by the likes of Meta and Alphabet.
Oh, I see. Sorry. Okay.
It's a few of these companies. So we think there's been a big pullback in this area. The prospects for this sector is still quite favorable. The valuations are not extraordinarily high. We think if there's a continued pullback, it would probably represent a buying opportunity, and this would be a space that would bounce back pretty strongly once the economy stabilizes.
In the likes of Meta and Google, you would put those in that basket?
Yes, that's right.
And just finally, bonds. Maybe we'll put up the U.S. 10-year bond yield. Would you be a buyer of U.S. 10-year bonds right now, say if your horizon was 1 year?
I think long-term bonds do allow for some stability and safety in portfolios here. So it is a good time to be having those in portfolios. Whether or not you want to be a buyer right here in terms of trying to pick up capital gains for on the belief that longer term yields are going to fall, I think that's a mixed bag here. I think there's a pretty fair value that these long term yields are falling within now. It's more for stability in portfolios, safety in portfolios. I think they have an important place that people are realizing these bonds provide that stability.
Thank